slightly better than expected, the same as CPI yesterday, coming in at 5.1%. And I think the market was looking for 5.1 or 5.2%, but there isn't a lot in it, so no big surprises on the inflation front.
No, we knew that as far as consumer prices are concerned, we are still going to get reasonably good numbers, at least for the next few months, because we have big increases over early last year, which are dropping out of the comparison. Agricultural prices have been well behaved. Oil prices have risen a bit, but nothing shocking when you look at the year-on-year comparison. Producer price acceleration, it's all to be expected, really, considering that oil has a bigger weight. Commodities have an important weight, which they hardly have in CPI. Therefore, it does make sense, considering the relative structures of the indices, to have PPI inflation picking up before consumer price inflation.
How about electricity? Does that start to show in PPI yet, or will that really be a couple of months after those tariffs are implemented by Eskom?
It will be probably within 1 or 2 months of the tariffs being implemented by Eskom. But we've got to remember that last year already Eskom had raised their tariffs quite significantly. So we are not going to see much of an impact on the actual year-on-year rate. Because basically,
you're coming off a high base already.
That's true. We already have about 25% annual growth in electricity prices. It's going to stay around these levels. So obviously, the first time that it happens, it has an impact. Or if it stopped, if all of a sudden electricity prices were flat, we'd have a nice disinflationary decline, nice decline in inflation. But it's not going to happen. It's the same with CPI. Most probably comes July, August. We're not going to see much of a change in the inflation rates based on just what happens to Eskom tariffs or municipal electricity tariffs.
And of course, we can look forward to these for the next few years anyway, can't we?
Yeah, no, we know that when we make our forecast for inflation, we have to include about 20-25% electricity price gains year after year for the next 3 years. That's a given, really.
Given that consumer inflation is starting to behave itself, it's in the target range, it's forecast to go lower still, and given the retail sales figures we saw 2 weeks ago, pretty dismal for February, contraction of 1.5%, one might have expected interest rates could be cut again, but the central bank governor really poured cold water on that last week. Do you think she could still back down on that?
She could back down, of course. I mean, she made it clear that the comment was not unconditional. Obviously, central banks have to be flexible, and if things change, they have to react. But I think it was a fair point that she made by saying, well, look, the economic data pretty much have been in line with expectations. The market made too much of the February retail sales figures. Yes, they were poor. They came after a strong January, so this is not the kind of indicator that goes in a straight line. I was personally not surprised. When you have a data like was strong in January, upside surprise, you're always likely to get a bit of a negative surprise the following month. If you look January, February retail sales put together compared to the fourth quarter, you have decent growth actually in consumer demand, probably in the first quarter. Now, obviously, if a series of economic data come on one after the other are negative, if anything, developments could be sovereign debt concerns in Europe, could be a fiscal tightening in Europe, could be a lot of factors, force the Reserve Bank and most analysts to downgrade their prospects for growth this year and next year, then of course the central bank would reassess its likely interest rate path. But not on a figure of retail sales, not on just 1 month.
Yeah. Of course, we had the IMF coming out last week and upgrading its growth forecasts for the globe as well as South Africa. I think it was looking at about 2.6, 2.7% growth for South Africa, which is slightly below what the market was perhaps expecting. But just given what we're seeing unfolding in Europe at the moment, we've had those downgrades of debt for Greece, for Portugal, now for Spain as well. Does this put a risk factor to the growth that we were expecting? Could this put growth at risk?
Potentially, yes, because at the end of the day, even though our exports to Asia, for instance, have been growing faster than our total exports over the past few years, they're still a minority. The Eurozone, or the whole of the EU, especially including the United Kingdom, we are close to 25-30% of total South African exports. So about a quarter of South African exports go to Europe. A lot of our companies, especially those who have dual listings, have operations in Europe. The world is integrated. We've shown it, we've seen it with the financial crisis of a year and a half ago, when production, when investment fell in industrial economies, it also fell in South Africa, even though South Africa didn't have endogenous banking problems and endogenous financial instability. The same could happen now. South Africa doesn't have per se a fiscal situation, an external situation which would warrant a crisis, but it could be affected by contagion, could be affected by trade links with a region, the Eurozone, which might have to revise down its growth forecast in the next few months.
What do you make of the way it's been handled in Europe? Do you think they've handled it right? Do you think they should have moved sooner before it's actually started spreading to other European countries and potentially globally?
Well, it's always difficult, in advance to know how the market is reacting, how the market is going to react, and what the breaking point is going to be. It is difficult for the potential providers of financial assistance to come out very quickly with a radical program, because it is not their money. It is the money that is lent by their citizens. They're accountable to their citizens, and German citizens, French citizens are going to say, well, we've tightened our belt. We've accepted lower pension entitlements. We accepted higher taxes over the years to reduce deficits. Why can't the Greeks, Portuguese do the same? Why would we have to bail out the Greeks because they didn't do what we went through? At the end of the day, the problem of the Eurozone, which we are seeing now, is that you have a monetary union, but you don't have a fiscal or political union, or an imperfect political union and a very limited fiscal union. So unless you do have institutional mechanisms to preempt these kind of problems, they are likely to occur again in the future, and politically and technically they're never easy to handle.
Now the rand has held up pretty well given the events of the past couple of days. It's gone to about 7.45, 7.46 against the dollar. Would you have expected it to weaken further, just given the problems we are seeing in Europe, given the weakness that we've seen with the euro itself? And obviously the rand is important for our inflation expectations and our growth expectations going forward.
It could potentially have weakened a bit more. If anything, there's been a resilience of South African assets, just like many EM assets, in particular because many investors have said, well, if we compare the fiscal fundamentals, the debt fundamentals, the growth fundamentals of the emerging world versus the developed world, there's relative attractiveness of the emerging world. So there's been a reallocation of portfolio funds from developed countries to emerging countries, which means that so far contagion has not happened, or if anything, some emerging markets have done better through the travails and the problems that the Eurozone has gone through. Now, of course, if you do get contagion, all emerging assets, especially in a liquid, volatile market like South Africa, would be at risk. And then I could potentially say the rand is the one that could experience the biggest downturn. First, because of its historical volatility. Second, because it is reasonably expensive at current levels.